If you walk down Wall Street today and ask a banker where real financial power lives, they probably won't point to JP Morgan or Goldman Sachs. Instead, they will gesture towards something far less exciting, a life insurance company. For more than 100 years, life insurance was the slow, boring corner of finance. It was a world of careful actuaries, long spreadsheets, and conservative investments. People paid monthly premiums, insurance companies bought safe government bonds. Decades later, families received payouts or retirees collected annuities. It was predictable, stable, and, honestly, dull. But over the past decade, everything changed. The tortoise was captured by the wolves. A new predator entered the industry: private equity giants. Firms like Apollo Global Management, Blackstone, and KKR began buying life insurance companies all over the world, not because they cared about protecting families, but because they discovered a hidden secret. An insurance company isn't just insurance, it is a massive pool of money, a pool that barely moves, and most importantly, a pool that can be used outside the traditional banking system. This is the story of how life insurance quietly transformed into one of the most powerful engines of shadow banking. To understand this transformation, we must return to the ruins of 2008. After the global financial crisis, central banks panicked. The US Federal Reserve slashed interest rates close to zero and kept them there for years. For savers and pension funds, this was a disaster. Imagine you're retired. You need a 7% return to survive. The bank offers you 0.1%. You are starving for yield. This desperation created the perfect opening for private equity firms. Traditionally, these firms bought companies, restructured them, and sold them for profit. But now they saw a new opportunity: lending money directly. Instead of companies borrowing from banks, they would borrow from private equity. The rates were high: 10%, 12%, sometimes more. It was extremely profitable. But there was a problem. To lend money, you need money. Private equity firms constantly had to raise funds from wealthy clients, and clients could say no or pull their money out. It was unstable. Then came Mark Rowan, co-founder of Apollo Global Management. He saw something no one else did: permanent capital. A hedge fund investor can withdraw money anytime, but a life insurance policyholder? If you buy a 30-year annuity, your money is locked in for decades. Pulling it out means massive penalties. To a financier, this is gold, a river of cash that cannot easily escape. So in 2009, in the middle of financial chaos, Apollo launched a new insurance company, Athene. The plan was simple. Step 1, sell attractive annuities to retirees, offer 3 to 4% interest when banks offered almost nothing. People rushed in. Billions of dollars flooded Athene. Step 2, instead of buying safe US Treasury bonds like traditional insurers, Athene sent the money straight to Apollo. Apollo then used this money to fund its private credit business. They lent to risky companies. They financed corporate takeovers. They bought aircraft leasing firms. Returns reached 8%, 9%, sometimes 10%. Here is the shadow banking formula. Pay retirees 3%, lend their money at 9%. Keep the difference. Banks do the same thing, but banks are heavily regulated. Insurance companies are not. Apollo had built a bank without being called a bank, a shadow bank, and it worked. Today, Athene provides Apollo with hundreds of billions of dollars in investment capital. Other firms copied the model. Blackstone bought Allstate's life insurance arm. KKR bought Global Atlantic. Brookfield bought American National. The entire industry shifted. But this new system created a dangerous conflict of interest. In the old world, insurance companies and asset managers were separate. The insurer protected policyholders. Risky investments were often rejected. In the new world, the asset manager owns the insurance company. Apollo owns Athene. Loans created by Apollo are bought by Athene. It's a closed loop. Create risky debt, sell it to yourself, store it inside retirement accounts. Critics warned this encourages dumping toxic assets onto insurance balance sheets, the same balance sheets meant to protect ordinary retirees. Worse, these assets are often level 3 assets, illiquid, hard to value, not traded publicly. Their prices are calculated using models designed by the same firms that created them. The company makes the product, sells it to itself, and decides its value. This has completely changed the risk profile of retirement systems. Instead of government bonds, retirements are now backed by private equity debt. It works beautifully during good times, but yield is never free. It's always the price of risk. And mixing hedge fund risk with life insurance promises creates something extremely dangerous. And to see how this system avoids regulators, we must leave Wall Street and travel to a tiny island in the Atlantic Ocean, Bermuda.
Your life insurance paperwork might say Iowa or Kansas, but the real financial engine behind your retirement often sits on a small island 1,000 miles offshore, Bermuda. Known for pink beaches and tax shelters, but for private equity firms, it is something else, a regulatory safe zone. To understand how this works, we must look at reinsurance. Normally, reinsurance is simple, insurance for insurance companies. It spreads risk, but private equity twisted it. Here is the setup. Apollo owns a US insurance company. Apollo also creates a Bermuda insurance subsidiary. The U.S. company collects $1 billion from retirees. Under U.S. law, it must hold large safety reserves, but Apollo hates idle money. So the U.S. company reinsures the risk to Bermuda. The liability moves offshore. And suddenly, the rules change. Bermuda allows insurers to use economic balance sheets, higher discount rates, lower reserve requirements. By changing the address, required capital drops dramatically. Money is freed, not by profit, not by efficiency, but by geography. This is called capital release. In reality, it is hidden leverage. Federal Reserve studies show this reduces safety buffers across the industry by billions, but that is not all. Bermuda also allows insurers to hold far riskier assets, private credit, structured debt, CLOs, assets that U.S. regulators dislike. So the risky loans are moved offshore legally. Your retirement becomes backed by private corporate debt sitting on a Bermuda balance sheet, owned by the same company that created the debt. No negotiation, no market discipline, just internal transfers. And when things go wrong, the risk flows back. This is called recapture. U.S. regulators demand the risk return, but the money is gone. This happened in 2008 with AIG. Off-balance sheet risk rushed home and collapsed companies in days. Today, hundreds of billions of dollars sit in Bermuda, betting private equity models are smarter than regulators. And inside those balance sheets, CLOs, collateralized loan obligations, the same structure that destroyed the world in 2008, only now it is corporate debt, not mortgages. A CLO bundles hundreds of risky corporate loans, slices them into layers, labels the top slice AAA, then sells it to its own insurance company. On paper, it looks safe. In reality, the underlying companies are drowning in debt. Interest rates are rising. Defaults are increasing. But these assets don't trade openly, so their prices are guessed, modeled, invented. They are alive until someone tries to sell them. This creates the ultimate danger: liquidity mismatch. Insurance companies owe money to retirees who can withdraw, but their assets cannot be sold quickly. If panic starts, if retirees rush to cash out, the insurer cannot raise money. It sells its safest assets first, treasuries, leaving only toxic debt. And unlike banks, there is no Federal Reserve safety net, no emergency lending. State guarantee funds are tiny. They cannot cover a giant insurer collapse. Caps are low. Funds are not pre-funded. In a systemic crisis, they fail instantly. This is 2008 again, but hidden, moved,
camouflaged. Risk migrated from banks to insurance companies, from transparent markets to dark balance sheets, from regulation to loopholes. Life insurance, meant to protect families, has become a high-stakes casino. The machine works until the credit cycle turns, and when it does, permanent capital may vanish. The Bermuda buffer may collapse, and shadow banks will cast a long shadow over the economy. In the next story, we will explore something even darker. In 1933, the government did not use shadow banks. They simply took people's gold, and history may repeat.